Hello, good morning. My name is Iveson and I am Senior Advisor of the Collar Institute of Private Equity. We are at the Private Equity Findings Symposium here at London Business School. And joining me today is Gillian Tett, US Managing Editor of the Financial Times. Good morning.
Good morning.
Gillian, thank you very much for your talk today. Are you surprised by the speed of recovery in the financial markets? And is this something that we should celebrate or be alarmed about?
Well, if you're looking at what's happening in the financial markets today, it's important to realise that there are several factors which are driving the recovery. On the one hand, there is relief that the economic outlook is improving. The real economy has rebounded from the 2009 recession, so that's good news. However, another factor that's also driving the recovery is a perception that the governments have underwritten many of the largest financial institutions. And that's potentially quite bad news, because one of the great unresolved questions from the financial crisis, and which financial reform has not really addressed, is the question of the too big to fail question. And as you're seeing in the Eurozone today, the type of concern about government debt is bound up with the fact that in countries like Ireland, governments are supporting financial institutions which they can ill afford to do. The third factor, though, that's also driving the recovery is the program of quantitative easing that's occurred in the United States. It's very unclear what's going to happen when that quantitative easing comes to the end of its current tenure in June. And there is a danger that people have been lulled into a false sense of security, because the amount of cheap liquidity that's swirling around the markets has prompted investors to chase riskier assets and given the impression of more normality and optimism than the underlying fundamentals actually justify.
In your talk today, Gillian, you mentioned the phrase financial repression. That's something that many may not be aware of. More commonly they have been aware of is quantitative easing. Could you tell us a bit about how the two are tied in together, if at all?
Well, recently there's been a lot of focus on quantitative easing, or the idea that governments buy bonds and try to stimulate the financial system through that. However, one of the ideas that's starting to circulate in the investment community and the central banking community is this concept of financial repression, or the idea that governments can also try and pay off their sovereign debts by encouraging domestic investors to buy local government bonds, either through overt controls or more implicit incentives. And if you look back over history, you can see, according to research done by Carmen Reinhardt and Sabrina Brancia, that in the period after the Second World War, one way that the American and British governments paid down their very large debts at the time was through that so-called financial repression. The key point about it is that if the bond yields are below the prevailing rate of inflation, and inflation doesn't have to be that high, then essentially you're seeing a subsidy from the investing public to the government, which enables them to pay off that debt. And that's something which investors certainly should be thinking about looking forward, even beyond the end of quantitative easing.
Thank you very much for that explanation. Thank you.
Thank you.